Any plans for Thanksgiving?
I got lots of people coming, so hopefully, I think everyone's vaccinated. So that's the saving grace.
Yeah. You cooking or is that on your wife?
We're about 50-50. We have like certain staple
Mm-hmm.
dishes. I really like David Chang has this great Brussels sprouts and fish sauce that at least is my responsibility. In addition to, I do the turkey. So
Gotcha. Are you also doing turkey for Christmas or you going for the ham?
no, we're I mean, we're originally from North Carolina, so we do a really phenomenal pork, like sort of crispy pork butt
Oh,
roast.
wow.
It's fantastic.
Yeah.
It's really good.
Yeah, because I know that there are people who go for the ham or for that, or will redo the stuffing and the turkey in Christmas as well. That's why, just wanted to make sure.
Turkey is such a. I mean, I like turkey. I like a turkey and bacon sandwich, but like it's very
Yeah,
bland. It's very bland meat. So you know, even for Thanksgiving, I find it a bit bland. But
that's why you need
it's
the
fine. It's cooking.
cranberries, and that's the only reason. Yeah.
That's right.
Okay, let's
Yep.
talk about the main thing because I think that this episode it's sort of a hey, let's do a quick episode and talk about Lemonade and Metromile and what does it mean for everyone, and we'll do it
Yeah.
without too many takes, not takes, edits.
Fantastic. Yeah. Good.
So, what do you think?
Well, I think that first I can see why Lemonade wanted to buy Metromile in that I think Metromile has really good experience with auto
Mm-hmm.
claims. Auto claims are very different from home and renters
Uh huh.
claims and pet claims. And Metromile's got an experienced claims organization that has seen these, and I think there is real value in that.
Interesting.
You
So you're the
know,
first one.
hundreds of
You're actually the first one who brought that up in terms of oh, they are looking for the claims experience because policy no. Maybe the sorry, they have 49 licenses in that
the
territory.
licenses. Yeah.
Maybe that is that a hippo spinnaker analogy? No,
I
no.
No, it's definitely not. And the other thing, one of the things that's not well understood about the licenses is there seems to be this belief that people have that says, oh, if I buy an insurance company that has a license to write auto in a state or license to write anything in a state, that instantly like speeds up my entrance to that state with my program.
Mm-hmm.
That's no, that is not a safe assumption. There are many states that if you buy a carrier that has the right to write insurance in that state, and even if you try to file your program, which is at least a little different from what that carrier had in that state, they'll make you essentially re-enter the state and get new approval like you were a new entrant to the state. And so it's not there. I mean, again, it varies from state to state, but anyone who would say like, oh, the fastest way to get into all 50 states is to buy a carrier with licenses in all 50 states hasn't done
Mm-hmm.
it because it's not some sort of magic wand in there. And so I don't think that the additional licenses are I wouldn't think they'd be particularly useful. At any rate, the going price for a license in a state is maybe $100,000 for like a line in a state.
Mm-hmm.
So I think if you look at the, whatever it was like $200 million price tag for this net of cash, you certainly wouldn't spend that for the licenses. I
So,
think one of the interesting things is. Oh,
yeah,
sorry. Go
no,
ahead.
because when I was looking at the deal or what we know about the deal publicly, right? 500 million. Uh, they already had like 200 million in cash. So basically they
Okay,
paid
so another three.
300
Okay.
million. That was, or was it the other way around, 200 and 300?
I thought it was the
Yeah, I
other way.
think,
I
yeah,
thought they had
yeah.
300
I
million
think that
in
they had
cash.
300 in
Yeah,
cash. So basically
yeah,
they bought Metromile for 200 million. That's what they're buying. It's not the number of
right.
policies because we've seen that Metromile didn't manage to sell too many policies, especially during COVID.
Well, I think Metromile has about 100 million in premium in force.
Okay.
So it was purchased for basically 2 times premium in force, which is a normal I mean, I would say for a carrier that's not growing, which is where I think you'd have to put Metromile, I would say they tend to sell more like 1 times premium. And I think if you looked at, if you applied like a root level valuation to Metromile, I think you'd be looking at, it would certainly be less than what Lemonade paid for it. Now
let's see that. Actually, now when you're saying root, let's check, because
I think Root's market cap. I think Root was
that's painful. That's painful.
Premium.
Yeah. So when we're recording this, Root price, it's $4.07. And their market value, it's less than 4 billion at this time.
Right. Well, and I think Root has 800 million. I think they're about a premium in force, and so but again, like they're not valued at 2 times that. Metromile had better retention, and I think sort of a comparable loss ratio scenario to Root though, but. One of the interesting things in looking at this deal is reading the blog post that Lemonade put up about why they did the acquisition. And I think, in reading it, they sort of talk about, they use lots of car analogies and metaphors in it. They give this, the argument is largely, well, we launched an auto program, and Lemonade did launch an auto program. We should talk about that. And so we launched, from Lemonade's perspective, they said, look, we launched an auto program, and it's very telematics based, and we need more data, and we need more expertise, and so when you pop the hood on Metromile, it's this amazing pricing ability, right? I think when I read that, my reaction was like, I think Lemonade bought a lemon, actually, is the better car analogy here, especially with respect to the pricing model. If you believed that Metromile had really unique, insightful data about telematics and driving, I think you'd have to reconcile that with their actual results, which are not good. I mean, there is a comparison to be made between Progressive, which hits its loss ratio targets, has tons of telematics data, has a filed telematics program, and which Lemonade copied for the program that they've gone live with, at least in Illinois. It's a copy of Progressive. So all of that is great. It's a great program. Progressive Auto is fantastic. Progressive as a company hits its loss ratio targets, is profitable. Metromile isn't. Metromile is a less segmented product. And so it's a little odd to see Lemonade go from having a copy of a program that does everything that I would think Lemonade would need to go after, the vast majority of auto insurance customers, and then veer off and sort of, I guess, use car analogies, kind of make a weird like left turn toward buying a product that hasn't been able to use its data to do anything profitable on the insurance side, and hasn't been growing.
And why do you think is that? Because I don't get it. During COVID, I would expect Metromile will go out and say, "Hey, you don't drive, you don't pay. This is what we offer. All those cars that you have in the garage that are gathering dust. Hey, use our insurance. If you don't drive, you don't pay. It's not a problem."
Right, pay per mile. I think, you're bringing up a great point, but that great point is every insurance startup likes to claim that they're targeting this really large market.
Yeah,
I think it pays to have a healthy sense of skepticism, to ask, what market are you actually targeting? And when I look at Metromile and I look at what product they've filed, I think they have in theory at least, they have a phenomenal product for people who want to watch their mileage and really like sort of extreme coupon their their auto insurance pricing. I mean, but I see that as a very small niche.
I think that,
and I think it's one of the reasons why it's really hard for Metromile to grow, is that it's really, as a monoline auto carrier, it's really expensive to advertise. I mean, it is like the most expensive thing to advertise, other than like mesothelioma lawyers. Those are lawyers who sue on behalf of people exposed to asbestos. Like, then it's like auto insurance in terms of cost per click. And so, and if you're targeting just a tiny part of that market, it's really hard to get customers. And so I think they're in this classic situation where they built a product that appeals to a set of people who they have a hard time getting to. I think it's also worth noting, most modern auto carriers, if you have cars, if you have excess vehicles, you pay less for them. Like, if you're buying insurance from Progressive and you're one driver and you have 2 cars, 3 cars, 4 cars, those extra cars cost a lot less. Like, baked into their rating is an excess vehicle factor to say, like, well, you can't obviously drive all these things at the same time. I mean, they do put effort into trying to find, undisclosed drivers in your household. But it's not like if you have lots of cars that you're not driving a lot. I actually wouldn't say that you should assume that a traditional carrier isn't able to get you the benefit of that to a large degree. But, there is a set of people who really want to just pay per mile. It's just a small number of people. And so that's
yeah, no, I completely agree. So when we look at that, okay, so Metromile, they did their IPO, they did an APO. So they tried to raise more money because apparently they had problems with liquidation. When we expected, our assumption was like, hey, no one is driving, especially at the beginning of the pandemic. People who should move, they didn't pounce on it. And now they're in a position that basically they were bought by 2x their income, more or less, right? And since then, yeah. So the question would be, okay.
Well, and not even income really, right?
Yes,
because like most premium. Of that goes out in loss. Just premium.
Yeah, false premiums. And from there, it's a question. It's like, okay, great. Did Lemonade bought data, which apparently maybe no. Technology, why should they have that technology if they can develop it or buy it from all the other providers, Cambridge, telematics. Thank you.
Yeah, Cambridge.
I don't know. Always we say Cambridge, I think about different companies that we should not talk about. So there are all of those solutions. It's part of them are already copy paste. So,
right.
What are we benefiting? Customer acquisition? No.
No.
Definitely not that. Is that a talent acquisition, acqui-hire of great talent, or is it what you just mentioned, which is the first time that I heard that, which is basically, hey, let's look at the claim process. Let's buy people not for the underwriting, but for the claims.
Well, I mean, certainly from my perspective, the most valuable thing that Lemonade got was the claims organization. I also look at Lemonade. So Lemonade has disclosed now that about 50% of its premiums are renters, and the other 50% pet and home. They publish a loss ratio in the 70s. That's actually a really high loss ratio for renters. The average renter's loss ratio is more in the 40s, and it's there because retention is low in renters. Lemonade has pretty average or potentially even good retention, although for a renter's home blend, probably just average. But most renters retain it like 60% because you move, and then you don't need that policy anymore. You got to get another policy. Maybe you buy it from somebody else. So, so Lemonade pays like a lot more in claims than, as a percentage of premium than most renters insurers. I don't know if that's because the way that they handle claims leads them to get more of their fair share of fraud. I don't know if they're underpricing the product. I don't know. And I mean,
Yep.
it's great. They're subsidizing renters insurance for people if that's the case. But I do think that there is a real benefit to Lemonade in having this claims organization. I have a really hard time seeing a benefit for any of the data for the reasons we've talked about. Just because I don't see them having leveraged it. I also see it as data that's fundamentally like niche product data, right? It's this pay by mile piece. And in theory, I would think Lemonade would be trying to address a large part of the auto market. And again, like this is the benefit of copying Progressive. I mean, it was a really smart thing for Lemonade to copy Progressive. It's weird for me why they would copy Progressive and then buy Metromile when they had launched Progressive in a state. But it's also weird to me why when Lemonade launched Lemonade Car, they only let you buy it if everyone opted into telematics.
I thought that Lemonade Car,
and-
that
yeah.
it's a Progressive program and they are just acting as an agency.
Oh, they're not an agency. No, there's a thing called doing a Me Too filing. So all of these filings, or most of them, are public. And so Lemonade Car took Progressive's filing and program and copied it and filed that as their own auto insurance product. And they filed it in at least Tennessee and Illinois, I think a couple other states. And Coverager did a little write-up on this as well. But it's like 99% the same insurance product that Progressive sells, which means it has the telematics, which they incorporated. I believe not based on any inside knowledge, but just based upon looking at the screenshots and everything, I believe Lemonade actually is using Cambridge Mobile Telematics in that product that they launched in Illinois, in order to do the that telematics scoring. But what was weird is, Progressive's product you can sell to anybody. Progressive actually goes quite far into what we would call, the non-standard insurance category. It's got prices for so many people. It's a really, really good product. Lemonade filed that and then went public with it in Illinois and only let you buy it if everyone on your policy opted into telematics. So immediately that cuts off just a large percentage of the population that you could sell an auto product to. And I think we talked before about a lot of auto insurers, startup auto insurers, have gone into market with really unsegmented products and have gotten, have had terrible loss ratios because they don't have proper pricing segmentation. Progressive has that. Lemonade filed that. That's what they went live with. And yet, instead of writing that full gamut, they came out of the gate and said everyone has to opt into telematics. And that's a huge cut down on the number of people you're going to sell insurance
I think
to.
this is a cut down on their onboarding process, and they are losing people at that specific stage of the funnel. And you talked about something very important in terms of, okay, you did a copy paste of Progressive, now you're going to market to everyone. And are you marketing to the right people? Are you actually hitting that segmentation? And we can talk about the different startups that are trying to do that. And then, of course, the price. Hey, you got bad risk. Did you price the risk correctly? There are so many different, variables that you need to tweak and tune. But something that you mentioned earlier, which is a little bit more interesting. Now, Branch, you're a multi-line of business. You have umbrella, home, rent, car. Do you do commercial as well, or only personal?
No,
so
personal.
Lemonade started with rent, add, a pet because you have pets in your apartment. Now it's a car. Later, maybe something else. I think they had some sort of life at a certain point. Who is going to follow that? Because Lemonade they're a startup. Is Hippo going to have rent and car? Are we going to see,
I mean,
Root going to try to
well,
get who is doing a Jetty or someone like that?
yeah, well, and Jetty, I think, has been pivoting more to selling less, at least to consumers, or actually, maybe they've moved to a security deposit
Yes, I
product.
think, yeah.
I mean, I would tell you that if you believe that the past is any predictor of the future in terms of how to build a successful large insurance company, that takes a large share of the market in the U.S., I think there are several things worth noting. One is most of the people who own homes own cars.
Yes.
And a JD Power study said 78% of homeowners bundle their auto. Now, that doesn't necessarily mean like home and auto with the same carrier, but it means that, let's say you bought your auto through Progressive and then you use Progressive's agency to buy HomeSite. Or let's say that you went to an independent agent and that independent agent bought you a home and an auto policy from two different places. So, but 78% of homeowners by this JD Power study are buying both home and auto together through somebody, like a single point. And another important fact is it is cheaper as an insurer to sell, like, you get a bundle discount for a reason. There are a lot of reasons why the bundle gets a deservedly lower rate. But if you bundle, you save. And these are largely compulsory products. If you have a mortgage, you need a home. If you drive, you need auto insurance.
Yep.
Right? Or sorry, if you have a mortgage, you need homeowners insurance, right? And so you've got products you have to buy that if you bundle, you will pay less for them. And if you bundle, you don't change a lot, which also then gives you a deservedly lower price. And so anybody who is claiming that they're going after either the auto or home market, I think really has to be selling home auto bundles, and then you get into the accommodation products that you expect to have, like umbrella, like motorcycle, like boat. These are products that, and life. I mean, people expect to buy these things, and Progressive's been talking about this on their earnings calls for like 15 plus years. The Robinsons is what they call them, right? And they have consistently recognized that unless they penetrate that segment, they cannot grow. And so everyone who has any aspirations on taking on State Farm, let's say, are going to have to offer these products, right? Because otherwise you're not going to get the customer segment. And so, I mean, you have two options. You can sell to a niche, own the niche, and then go sell to another niche, or you have to have the cheapest price for a whole lot of people for a long period of time. That's how you win.
I completely agree with that. And I just wonder about the different M&As that we see startups buying startups, and when are we going to see an incumbent carrier buying a startup in order to do that growth?
Well, USA bought Nobler.
Yeah, right. Sorry, I take it back. Yep.
And so, there's an interesting world in which Lemonade had bought Nobler a year ago. I think that would have made a lot more sense, honestly, before they launched Lemonade Car. By the way, Nobler built a great Progressive clone.
So everyone is based on Progressive, or there are a few like nationwide out there?
No, so most auto insurance startups have decided not to copy Progressive because it's really hard. It is extremely difficult to copy Progressive because Progressive makes it really hard. And so a lot of other filings, especially less segmented filings, are easier to copy. So Root, for example, took like a couple pieces of Progressive, but didn't miss that, has continued to miss out on lots of segmentation that's in Progressive. Now, if you listen to the Root earnings call, what you'll hear from their chief insurance officer is about how they're adding more segmentation. So, I mean, they're aware that that's something they need to do. But I think Clear covers a Geico copy, which is less segmented than Progressive, but is still pretty good. Loop is a recent entrant, and I believe they're a copy of Root mainly, with like some additional Progressive factors put in, but largely Root copy. So yeah, most people haven't copied Progressive. So if you think about what Lemonade has spent building a Progressive clone and buying Metromile, and you compare it to what Nobler cost, I think owning Nobler before building out the Lemonade car team would have been a great idea.
Yeah. Actually, Loop is interesting. New entrant, right? What is the value proposition there? They've done great marketing, industry facing. Oh my God, I forgot her name now.
Carrie Ann Nadeau?
Yes. Great job building the story, the narrative, all the marketing. The team pictures very well. Were they live, and do you know if they already sold the policy?
I think they've sold policies.
Okay,
I think they're live in Texas.
Okay, so one of the big ones. Yeah. Fantastic. Yeah. Yes, she's based out of Austin. Right. Yeah.
Yeah. Yeah, I mean, they're an MGA. As far as I know, they haven't published any numbers.
It's too
I mean, it's very early. So, I mean, but I agree, their marketing is absolutely phenomenal. I think they've got, I think they have a lot of people working on it. But yeah, they're definitely punching well above their weight. In terms of
listen, compare that to Lemonade, and Daniel is a master. He's, I would say, the superstar of marketing. And sometimes, in my opinion, all the claims or lack of claims organization at Lemonade, it's their marketing. It's like, hey, just submit a claim. We'll have a counter. We'll say it's an AI. In 3 seconds, we'll tell you that it was approved, and there you go. Go tell your friends. And that's a cheap customer acquisition. And if we are looking on the different ratios, instead of being at cost, because we don't want that cost of a customer acquisition here, we're going to move it to the claims. And that may affect our ratio. But our VCs, well, that was 7 years ago, they are looking at CAC. They don't understand what's loss ratio or combined ratio because, well, it's not there yet. So it's absolutely fantastic. But again, it's my theory.
It is. You're right. I mean, the one thing I wish venture capitalists understood was that there is a real issue in applying the software as a service economics to insurance, where if you misprice insurance, you lose money every minute that person is a customer of yours. And so when you look at companies that have loss ratio plus LAE, and this is actually an important thing. We could do a whole episode on interesting metrics that insurance startups
we touched that last time, and we can continue talking about it next time as well.
Have put in their or published. But one interesting thing is this startup desire to pull the amount paid out in losses from loss adjustment expense, and to try to hide the loss adjustment expense and sort of not acknowledge that it should be considered there. But I that is something that you should look at together, and it's certainly not a good sign when the amount you're paying in losses plus the amount you have to spend to adjust those expenses is greater than the amount of premium you bring in. That's a definitively upside down situation. You're undercharging. I mean, you're absolutely undercharging. You're not, and the most profitable companies, that number's in the 70s. And so, you've got insurance startups who have that number in the high 80s. Just the loss part, they got another 10 to 15 points for loss adjustment expense, which is putting them over 100, but they're going around talking about it and ignoring that loss adjustment expense and then comparing it to everybody else's number that includes it. I'll give you the other metric that I find very suspicious is this net retained premium metric. And so most insurance companies, when they talk about retention, will talk about, when they would say like 90% retention, they're talking on a policy basis, right? So let's take this case. Let's say I have 100 customers. Let's say I have 10 customers, okay? And collectively, they're paying $1,000 each for a policy, okay? And then when it comes to renewal, okay, one of them departs. So now I have 9 of the original 10. Now, most insurance companies would say this is 90% retention, okay? Because you have 90% of the people still, 90% of the policies are still there. But if you raised your premium by 12%, let's say, and now the 9 people are paying you as much as the 10 were before, so you raise the rate enough so that they're making up for that one, you could actually have a retention of like 102%. And there is, and this is actually Hippo's metric of net retained premium. They talk about retention in terms of retained premium, but that means that they can improve retention by increasing rates. And I've never seen a retention metric where increasing your price for the same product would improve your retention. And so it's an apples and oranges metric from the policies you retain. And what's fascinating to me is that nobody seems to be aware of this. And so when you read articles or you read analysis, they will cite that number alongside like a progressive retention number, which is a policy retention number. And they're not. They're different numbers.
No. This is fantastic, man. No,
well, and I can also add, I can tell you why. Where did this metric come from? So this metric comes from software as a service. This is, again, this problem in applying software as a service metrics to insurance. So in software as a service, there's this term called net negative churn. And you can Google it. It's useful. But it talks about the fact that, like, when you as a company buy a software as a service product, if you're really using it and you love it, you'll spend more for it over time because you'll add users, you'll add features, they'll come out with new things, right? You'll pay up to the next level. And so that's a really useful measure to say, oh, I've got net negative churn because if I look at my customer base last year versus this year, actually paying me more. The problem is insurance is somewhat commoditized or very commoditized, depending on your point of view, in home and auto. And you're usually not, I mean, when you renew a policy in homeowners, you're insuring the same thing, usually with the same coverages, right? Like you tend not to be changing a whole lot. And so paying your insurer more every year is qualitatively different, I would say, than more people retain in the business.
There are no new features, right?
Right, exactly. I mean, yes. I mean, there could be new features, but usually there are not. It's not a common
Once a few years, something will happen. Or from your side, not a claim, but hey, we have, I don't know, better standard of living, more risk, something will change.
Well, we have inflation, it costs more to replace things, we're having supply shortages. All of those things will cause your rate to go up. I think it would be a distorting internal metric to commingle, like these people are staying because they love us and we're giving them a good price, with we made more money off these other people because we increased the price. Right? Those to me are two different things. And so there's meaning to me in saying what percentage of policies renewed. And if I ignore that number and I just say, give me the premium amount cohort by cohort, I actually think I could miss out on huge problems that I had in underlying retention that are sort of hidden. And in fact, Allstate, for example, has been net shedding customers for like 30 years, but the amount of premium they have collected year over year over the last 30 years has increased. So their insurance rate increases, and the largely just inflation and the cost of paying claims and all of those things has gone up at a higher rate than the defection away from Allstate and their customers has been to their premium. And so like their rates go up by say 5% a year, but their total premium in force is only going up by like 1 or 2%.
Which is fine, because at
And
the
so,
same time, they are keeping the type of risk that they want and can pay that premium that slowly crawls up.
I mean, maybe,
Okay,
yeah.
you
I
know,
mean, I think in the end, you don't want to. You would like to not net shed customers for 30 years. I think.
that's a
I don't
different
think that
problem.
would be seen as true. But I think this is the problem. Like, if you just looked at that premium number, I think you have this distorted view, right? And I think there's value in retention measured on a policy basis, or on a customer basis or whatever, and not on a premium basis. But anyway, like these metrics make it really hard to evaluate these businesses, especially when you have investors who are just not used to all the gaming, right? If you're a software as a service investor, I think you really understand how people game these metrics and how to do due diligence. And like we're still very young in understanding the way insurance companies, if they wanted to publish more vanity type metrics, like what would those look like, and how do we
So,
evaluate
I
if
think
they're
that at
good?
this point, especially when we're talking about investors, they already progressed, right? 7 years, 6 or 7 years into the insurtech space, and we already see the change of the generation. So we are seeing people who were principals or even partners in one fund now are GP in a new fund. More and more, not CVCs. Well, you have CVCs that started their second, if not
Yep.
third fund. No, most of them are second fund. But then you have specialty VCs that's their core. And without naming too many names, we love them all. But
Yes.
but there is still some sort of no, I can't call it. There are so many smart people out there, so it's very hard for me to say, oh, they don't get it. So what are they missing? Because they know it. Is it only the people from outside who don't get it, or is it?
Oh, I think that the insurance specific investors have a very good set of have very good understanding. Yes, I do think that it is the not the investors who invest in all sorts of things, and I think it takes a very. I mean, we have some investors from outside of insurance who do really get it and really
Mm-hmm.
understand it, but in my experience, it's a rare thing.
Yeah.
And so, but no, I do think the insurance investors really do understand loss ratios, targeted loss ratios, and I do think that they make good, sophisticated choices. So yeah, I am really talking about more of the generalist venture capitalists, and I also think, I think that there are, retail investors who are used to um, investing in insurance companies, perhaps, but not, insurance companies. Public insurance companies generally talk about the same things in the same way. Because there's certain statutory reports you file and ways of working, and so there hasn't been a ton of non-GAAP
Mm-hmm.
measures coming from public insurance companies that are sort of like, but not entirely like, more traditional metrics. And so, um, it would be good to have a little skepticism of like, help me understand what this means. I think the last time we talked, I think, the two questions I love everyone to ask, to say is that how good is this business, is the one on, well, what loss ratio did you target and what did
Yeah.
you hit? And if they differ by a lot, then why? Right. And there I mean loss ratio plus LAE. And the other question I think, which is raised by the Metromile acquisition, is like, what is the addressable market of this product?
And I will
So
add
if
what will
Metromile
be,
has pay
and
by
I will add,
mile,
oh, for the investor part,
yeah, yeah.
what will be the multiply that you're expecting? because there is a lot of question. Are you
Yes.
a technology company that sells insurance, or are you an insurance company with great technology? That's one.
Right.
Different multipliers. Then there is another thing that I think, because I don't have the numbers in front of me, we can talk later on about this specific deal and the fluctuation of the price of the shares, because one share of Lemonade, they got 19 shares of Metromile, or the other way around, which after a little bit here, a little bit there, you go like, yep, there are that 200 million. It's not even 200 million anymore. But sorry,
Right. Yep.
I diverged that.
Yeah, no, that's a great point. Yeah, and I would be terrible at predicting where any of these stocks would go, but I agree that in these like stock deals, it's going to be really interesting when it takes months to close and there's like a lot of volatility in the stock price, whether that causes deals not to get done or whether they get substantially renegotiated, close to the closing time.
Well, maybe that's enough for today. What do you think?
Sounds good. Yeah.
Listen, we said, hey, let's do a quick conversation, a lightweight, something about what happened. Maybe throw in a little bit of gossip. It's been like 41 minutes, and it became like this serious Q&A, which that's fine. We are sort of serious people.
That's great.
Yeah.
Yeah.
We love our numbers.
It's good. It's great detail.
It's very hard to say no to. It's like to geek out on insurance and numbers. It's hilarious.
Yep.
Yeah, likewise, man.
All right.
See you next time.
Great.
Cheers.
Thanks a lot. Talk to you later.